Was this the right call?
I think it was. It was certainly what most economists and the financial markets had been expecting after the CPI release for the September quarter just under 2 weeks ago, which in the eyes of most people, and now clearly the Reserve Bank, did represent a material change to the inflation outlook. And given that since taking up the role of Governor of the Reserve Bank, Michelle Bullock has introduced into the Reserve Bank's communication the notion that the board has a low tolerance for material changes in the wrong direction to the inflation outlook, it would have been surprising if they hadn't raised interest rates at the first opportunity after the September quarter and September monthly CPI figures.
So will this finally get household spending down to ease the pressure on inflation?
Well, that remains to be seen. I think the Reserve Bank, like others, has been surprised at how resilient household spending and economic activity more broadly has been in the face of that series of interest rate increases since May of last year. Some of that, of course, is due to much faster than expected population growth. And in per capita terms, the Australian economy has actually gone backwards for the first 2 quarters of this year. And we'll find out in just under a month whether the same thing has happened in the September quarter. But that population growth has contributed to additional inflationary pressure in particular in housing, in rents and in house prices, which the Reserve Bank also referenced today. Households have been willing to draw down on the considerable volume of savings they accumulated during the COVID period to sustain household spending, including on discretionary items in the face of falling real incomes and, for those with mortgages, rising interest rates. And although higher energy prices have added directly and indirectly to inflation, since Australia is a net exporter of most forms of energy, that's also represented an additional source of growth in national income, which to some extent has probably offset the impact that higher interest rates would otherwise have had on the level of domestic spending.
So taking into account Australia's current struggle with inflation, should the migration level be at the level it is or not?
Well, the level of immigration is not determined in accordance with or influenced by considerations about its impact on inflation. And in all likelihood, the surge in immigration that we've seen since Australia's borders reopened at the beginning of last year contains a significant element of catch-up to make up for the 2 years in which our borders were closed to not just tourists, but international migrants. And if population growth eases off, some of the inflationary pressures that have come along with the strong growth in population we've seen over the last 18 months will also tend to abate. And that's certainly what the Reserve Bank expects. What the Reserve Bank will also be looking at, as it's made clear today, is whether productivity growth, which has been negative over the past year, picks up so that the pickup in wages growth, which we've also observed, and which is likely to have picked up further in the September quarter, we'll get data on that on the 15th of this month, that doesn't become another source of inflationary pressure, which it certainly has been, for example, in the United States and the UK, so far hasn't really been an important contributor to rising inflation in Australia, and the Reserve Bank wants to make sure it stays that way.
What's the latest information on the number of borrowers struggling to meet mortgage repayments, and is this decision likely to put many more people in that category?
It will undoubtedly put some more people in that category, as the Treasurer said in the excerpt that you played earlier. But I think it's worth remembering that Australian mortgage default rates are almost always lower than in comparable countries overseas, partly because having a mortgagee in possession sign go out outside your house is one of the few things that in Australian culture carries a great deal of stigma. And Australians have traditionally been extraordinarily reluctant to allow themselves to get into a default situation on their mortgage. They will traditionally do whatever they can to hang on to their house. And so far, despite the pressures associated with rising interest rates and rising cost of living for those who are on mortgages, households haven't really cut at least in aggregate, discretionary, let alone essential spending to any significant degree. As the retail sales figures that came out last Friday illustrate, Australians are still spending surprisingly freely on a broad range of what most people would consider discretionary items, as well as the must-haves like food and housing and utilities. I expect we will see some significant slowing in a broad range of areas of consumer spending over the course of the next 12 to 18 months. And indeed, if we don't, then the risk may well be of further increases in the Reserve Bank's cash rate.
Yeah, so from where we're standing now, do you think another rate rise is on the cards?
I don't think it's on the cards, and it's possible to interpret the language of the Reserve Bank's final paragraph in today's post-meeting statement as signalling that perhaps there's less chance of another rate rise than there had been. The door is still open to a further increase in interest rates if inflation again surprises on the upside, but if inflation behaves as the Reserve Bank now expects it to do, it's revised its forecasts for inflation up by 0.25 percentage point over the course of 2024 and 2025. If it's no worse than that, then probably there won't be any further increase in interest rates, but nor should anyone be anticipating any reduction in interest rates, in my view, for at least 12 and possibly 18 months.
And finally, there's political to and fro over whether the government is adding to inflation with some of its policies. What do you make of the way the government is approaching this?
I think the government's been responsible in the way that it's approached the undoubted political pressure to provide assistance to those, especially in the bottom half of the income distribution, who are facing a genuine squeeze on their living standards as a result of rising prices for a broad range of essential as well as discretionary items. And if they have a mortgage, rising mortgage payments as well. So it's understandable that the government would want to do things to assist people in those circumstances to cope with the pressures that they're now under. But against that, the government has had to be careful not to be so generous in helping households cope with these pressures that they fuel additional spending that in turn makes the task confronting the Reserve Bank of bringing aggregate spending into line with aggregate supply more difficult than it would otherwise be. And the government can, I think, rightly claim credit for having diverted almost all of the windfall revenue gains it's received since coming to office as a result of persistently high prices for energy and other export commodities to improving the budget bottom line, rather than using them to cut taxes or to increase government spending in ways that would put additional upward pressure on demand and hence inflation. So I think for the most part, the government has aided rather than hindered the Reserve Bank in its battle against inflation, but that battle is far from won as yet. Even though inflation's heading in the right direction, it's heading down more slowly than it is in, for example, the United States or continental Europe. And the Reserve Bank will continue, I think, to demonstrate and to insist that it has low tolerance for any further deviation in the outlook for inflation from the revised forecasts that it will be issuing in more detail on Friday.